Hello and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Abhishek Singh. He's fund manager at DSP Investment Managers. Welcome, Abhishek.
Thanks for having me on the show.
Good to have you here. Now, to begin with, can you please share with us what drew you to financial markets in the first place?
I wish I could tell you that this is something that I wanted to do since I was 10 years old, but unfortunately, that is not the case. Um, like many other people, I kind of drifted for some time. So I was always attracted to sciences. I had quantitative aptitude. So when I was in school, my neighbors actually studied at IIT Kanpur, a couple of brothers. And they told me that JEE is this exam that is very good, and IITs are a good places to kind of study, good colleges. So I wrote JEE, and fortunately, I got accepted. Uh, and then after 4 years, again, there was this question: what do you do? Again, I was told that CAT is something that everybody's writing, so I wrote CAT. And in the MBA college, that is when, while reading one of the books by Taleb, actually a book on derivatives, a friend of mine suggested that you should read one of his other books, which is Fooled by Randomness. And that is something that I found very interesting. This concept of non-linear payouts kind of uh, attracted me, held my attention, and that is what I think kind of started the journey. And then from campus, I started looking for jobs in trading, in investment management, and that is kind of what started this journey.
But Abhishek, doing mechanical engineer from IIT Kanpur and then moving to doing the post graduation business administration, what was the trigger or what was the thing which led you to do MBA?
So actually, I'm an electrical engineer from IIT, and I was a horrible engineer, Chirag, to be honest. So those 4 years, uh, I was not focused on engineering at all. So most of that time, I was reading fiction. I was into music, so everything else apart from engineering. So I was pretty sure that engineering is not something that I would end up doing with my life. And that is the point when you start exploring what else, if not engineering. If you're not applying for, let's say, masters, or if you don't want a job in a core job in that sector, what else can you do? So as I said, you keep drifting until you find something that you like doing, that you want to do, and you start getting serious in your early 20s. Honestly, that is when you start thinking about this big question: what do you want to do with your life? Yeah, so I would say some people are fortunate to have that clarity very early on in their life. I was not one of those people. So,
So Abhishek, could you just help us with the starting journey? You worked with Edelweiss and Kotak Securities. Could you just share with us what was the thing which you used to do and what were the key learnings which is helping you right now in the fund management
sure.
business?
Yeah, so on that front, actually, I was very fortunate. So I was hired by Kotak from campus primarily to look at the risk management for their option trading desk. So they had a big desk, and there were some things that they wanted to improve upon, and I was hired for that role. So I started as a risk manager in the proprietary trading desk of Kotak Securities. Eventually, I started trading options, kind of set up their structured products book. I traded or managed a structured, a systematic trading book for them. I traded currencies, commodities. So it was a very diverse exposure early on, and basically, even today, when I hire somebody new, let's say, I ask them, or the focus is always to start with the risk management, to start with things that can go wrong, then start thinking about how to build portfolios, and then eventually go to individual sectors and balance sheets and stuff like that. So I was fortunate to basically be put on that path unknowingly. So unknowingly, unconsciously, I started as a risk manager, then started backtesting strategies, thinking about portfolios, and then later on, I was managing a long short book for Kotak. And that is when I started looking at individual stocks, businesses, sectors, stuff like that.
And after working with Edelweiss and Kotak, what was the why shift to the asset management business? Any
Yeah.
particular?
Yeah. So, see, when you're running a long short book, all of the activity is on the short side. So I was looking at my portfolios, and most of my holdings on the long side of the portfolio, I was holding them for multiple years. So there was very little churn on the long side of the portfolio. And the approach that you adopt for shorting is not a mirror opposite of the approach that you have for your long. So that is a very, very technical and a very, very tactical tactical book. So constantly it's a daily battle that you have to fight on the short side. And that is something that I was not comfortable with. And again, then later on in my late 20s, you start thinking about this concept that you should be working on something where you can keep compounding for a long time, even in terms of learnings that you're building on, you're getting. And so I wanted to always focus on the long side of the portfolio. And I used to write a lot. I used to post my thoughts on social media, on my own blog. So some of those things somebody shared with the management at DSP, and that is how we started talking. And eventually, I moved from being a trader to a fund manager, to an investment manager. This is something that I always wanted to do, and again, was lucky enough to get this opportunity.
But any key learnings from that period which is helping you right now, which has shaped up your thinking on the fund management business?
Yeah, yeah. So, see, I keep telling people that active funds are reflections of fund manager personality. So you will always, so two different people will manage very differently. And I'm inclined towards thinking about what can go wrong. I mean, it's in your personal life, it can be a curse. You are always thinking what horrible thing can hit your finances, hit your family at times. And as a risk manager, that is primarily your job to think about what can what all can go wrong in the business in your book. And my opinion is that fund managers primarily, before being investment managers or money managers, they are risk managers. So that thought is very, very well ingrained. Even in terms of building portfolios, the way I think about portfolios or individual businesses or individual stocks is start with what is the downside, what can go wrong. And at least my experience has been it's very hard to predict the upside in businesses. Even when you speak to promoters, managements, sometimes it's so surprising that even they were not sure that this is what how good the prognosis can be for certain businesses. So you focus on downsides, and eventually the upsides kind of take care of themselves. That was the key learning, again inspired a lot by writings of Taleb.
Abhishek, now that you've painted this interesting picture for us to, understand about your background, we'd like to move to what you're doing right now. So, how do you sum up your investment philosophy for managing both equity and hybrid funds?
See, there are a lot of debates in investing that rage on, and a lot of these debates, for example, concentration. Is concentration good? Some of the biggest fund managers, Bill Ackman, for example, runs 11 stock portfolio. Charlie Munger at one point was running a 4 stock portfolio. Warren Buffett at one point had 20% of overall market cap in a single stock. So there are a lot of believers who think this is good, and on the other end, the index that owns pretty much everything ends up beating most of the fund managers. So is concentration really good? So there are multiple debates in investing that go on and on, primarily because the context is different. People debating have different contexts in mind. But does that mean there's nothing in investing that is enduring, that is kind of the holy grail? I think there are a few things, and they are all about adopting simplicity and focusing on the margin of safety. My three core beliefs are that to make money consistently without being lucky, you have to buy something for less than its intrinsic worth. So you are trying to buy a dollar bill for, let's say, 80 cents or 60 cents or whatever. So you have to buy it cheap. That's the first belief. The second belief is nobody knows. Uh, um, in fact, we publish a document called the transcript. The latest edition will be published tomorrow. And we end that document with a slide where somebody, an expert, somebody really good, made a prediction about something which turned out horribly wrong. So life and markets have a habit of surprising the consensus. That's the second belief. If you put one and two together, then the only intelligent way to operate, in my opinion, in my belief, is to buy low implied expectations. You buy stuff where market is building in very, very benign growth, or has very, very benign expectations of improvement in profitability, where a lot of pain is already in the price, and then markets surprise you positively. So that is the core belief or core approach based on which I try to create portfolios, manage portfolios, and the approach is pretty consistent, whether it's a equity fund or a hybrid fund. You have one single portfolio in your mind that you kind of try to express in different funds.
You mentioned three core principles: buying cheap, market surprise you, and what was the third one?
So basically, the way I put it is structure beats activity.
Okay.
Your structure should be such that over time it should end up giving you satisfactory outcomes. If you try to go for very high upsides, you also take the risk of ending up with very bad performance. Other way to think about this is, I think investing returns go to those people who are not chasing them too vigorously. For example, if as an individual investor, you start going for 20-25% return, if that is what you start targeting, then most probably you will end up making lower than debt returns. But if you are really happy with 12-13% kind of return, which is typically what an investor in India should expect over time, 10-13% kind of range, then your actual returns could be higher, because you will not make mistakes. You will not get into strategies that are too complex, too volatile, stuff like that. So structure beats activity. Adopt simplicity, basically.
Okay.
Abhishek, but getting the stocks which are not doing well in a very layman terms, which are not doing well in the markets currently, you hunt for that kind of stocks. But that can be one part of the portfolio. What about the remaining part, or means how do you structure that thing?
Yeah, so see, as I said, buying and selling decisions are not like mirror opposites of each other. Ideally, what you want to have is, 60-70% of your portfolio should be doing okay, should be beating the benchmark. 30 odd percent of your portfolio, these are broad numbers,
Yeah.
should be struggling at any point in time. If everything is doing badly in your portfolio, then obviously there's a problem. But if everything in your portfolio is doing well, then also it means that you're probably not diversified enough. At some point, if the cycle changes, or maybe you're just too aligned to a certain theme. So like 4 years ago, there were many portfolios that were just too aligned to this whole quality at any price theme, and they were doing phenomenally well. But then everything kind of goes for a toss. The whole portfolio is struggling. So when you are buying, you want to buy stuff where there is some pain, the expectations are very, very benign, and over time you hope that some of these things will get into momentum. People will come around to your view. Basically, you want the market to come around to your view, to your way of thinking, only later, not today. Not today when I'm buying my position. I want the market's view to align with my view once I've built my position. So ideally, majority of the portfolio should be doing well, but some 20-25%, 30% odd portfolio should be in stuff that is struggling at that point in time. Of course, the execution, there are challenges, you struggle at times, but that is the broad approach.
Abhishek, now coming specific to the large cap fund which you manage apart from the hybrid funds, do you still think that large cap can outperform the benchmark indices? Because in the last few years we have seen passive funds in the large cap thing uh, doing better than the active funds. What's your view on it?
Yeah, so the benchmark, Chirag, if you look at the SPIVA report for June 2024, almost 100% of the funds in the large cap space over the 5 years are underperforming the benchmark. And the statement that you made was that passives are beating the active funds. The benchmark is beating the active funds. But passives themselves, even in direct schemes, have 30-40 bips of slippage. So your opportunity cost is not index TRI, it's index fund. And index fund returns are different from index TRI. But ignoring that fact, and I'm not against passives, I think passives make sense for a lot of people, majority of people. Uh, you have to think about why is it that the large cap funds particularly have struggled to beat the benchmark. It's not because large cap is more efficient. I don't think that is the case. It's not because it's more competitive. Again, I can share data that that is not the case. I think the primary reason is large cap funds overall as a category has they have failed to create portfolios that are very different from the benchmark. So if you look at the average active share in the large cap space, it's 40% odd. Now, 40% active share is the textbook definition of closet indexers, less than 40% active share. So I think most of us are not even trying. With 40% active share, occasionally you can get outperformance, but on a structural basis, you have a 2% headwind in regular schemes, which is your TR. It's hard to beat the benchmark over full cycle, and that is what is reflecting in SPIVA reports. So I think people who are creating portfolios that are different and who have an approach that is sound, intelligent, will end up beating over time. And there are enough funds who are doing it. Not in the large cap category, unfortunately, especially the last 5 years, 3 years. If you look at the 3 year data, it is pretty good. But yeah, that has been the primary challenge in the large cap category: low active share, low deviations from benchmarks.
So how do you plan to improve the performance, or how do you differ from the other large cap things to outperform
Yeah.
or generate the alpha?
Yeah, so Chirag, this is something that was written almost 75 years ago by Graham. That too, if you want average performance, you go and buy an index fund, and you'll do well. Most investors will do well. If you want better than average performance, then you have to do two things. You have to do something that is not popular on Wall Street. In our case, basically adopt an approach that is not popular with in the market. And second, your principles of operations need to be sound and intelligent. So the first step, I mean, we have done. I mean, our portfolio has 60 odd percent active share. If you look at our portfolio in the large cap space, we have only 22 holdings from our benchmark of 100 only. So it's a 32 stock portfolio. I own only 22 stocks that are part of the benchmark. 11 stocks are out of the benchmark. 21 stocks that are part of the benchmark, and 11 stocks that are out of the benchmark. So our portfolio is very different. Some of the largest weights in the benchmark we do not own. Now, this is not something that we kind of target. That the objective is not to create a portfolio that is different. The objective is always to create a portfolio that we think have the best risk reward equation. It just ends up being a portfolio that is very different from the benchmark. So that step we have kind of achieved. Whether our principles of operation are sound and intelligent, unfortunately, that you will know only 5-7 years. The last 2 years that I've managed the fund, the performance has been much better than at least what I expected. So last year alpha was 3.5%, this year 6%. At the same time, 1-2 year is noise, Chirag, in equity. We should not pay too much attention to these numbers. The proof of the pudding will be when we get to full cycle returns, which is 5, 7, 10 year kind of returns. But I think this approach is the only way to operate in the large cap space. If your objective is to deliver performance, which is better than the benchmark.
Now, you've expressed optimism about sectors like financials, there's consumer discretionary and healthcare. Are you still bullish on them? And What specific factors make them attractive in the current market environment for you?
So, Ruchira, the way I think is I'm least bearish on them. So, bullish, as I said, you always try to focus on the downsides and the upsides. It's hard to kind of predict. See, one reason to pick BFSI, for example, is if you look at which sectors are trading at valuations which are, if you look at the history, below 10-year averages, or only BFSI is the space, a large space that is trading below 10-year averages. At the same time, sometimes we get too focused on what they're going to do in this quarter, next quarter, what's going to happen if there's interest rate cut, whether the names are going to compress by 5 bips or 10 bips. If you look at their ROE profile, I mean, there's a high probability that irrespective of what happens in the economy, they'll continue to deliver 14, 15, 16, 17% kind of ROE. So if you think about how the space, at least the lending space, will look 3-5 years out, they would have delivered 15 odd percent ROE, or that is the kind of compounding in the underlying value of the business. And today they are trading at valuations that are not expensive. In some cases, they are outright cheap. So I think you should not expect significant derating in the valuation multiple. So you end up making the underlying growth in the profitability, which is mid-teens. So you stand to make mid-teens returns there. That is my expectation. And this is not something that you can say with the same confidence for a lot of other sectors. And that is why the larger weights here. Pharma, we started buying almost 2-3 years ago. And at that point in time, Indian branded businesses were available at 12-13x EBITDA. All of the exports piece was available for free, basically, in most cases. So from 4% exposure, the exposure went up to 18%. And that, because that's a sector that has done really well. In spite of all the debates being around infra and capital goods, if you look at the 5-year returns, the segment that has performed the best is actually healthcare. So that is something that helped us. And last few months, if you look at the fact sheets, we have been reducing positions, and now it's close to 10 odd percent. The overweights have reduced. The other bit is consumer discretionary. That is primarily autos. And I think if you look at most of the stocks, at least our holdings, they are trading at or below index multiples. At the same time, their EPS growth is better than what we expect from diversified indices. And the profitability is significantly higher. If you look at the ROICs, ROEs, they're significantly higher than what we have for Nifty. So again, a space that at this point seems okay on a relative basis. In
Abhishek,
some cases, absolute basis as well.
Abhishek, before I come to the next question, I just wanted to understand one part on that large cap thing. You spoke, you have out of the 33 stocks, 21 stocks are in the benchmark and the another 11 are in the outside the benchmark. So what's the, how do you approach buying stocks in this portfolio? What's the approach?
See, so one pushback that you get when you pitch a large cap fund is that your universe is limited, only 100 stocks. So the definition of the large cap category is 80% of the weight that they have to come from the top 100 companies only. Now that's a fair pushback, but at the same time, it improves your focus as well. So I can go to every stock and then give you my reason why I want to own this or why I do not own this. So 100 stocks, and then if you bunch them in segments, there are few large segments. I mean, there are 5-6 private banks, a couple of PSU banks. You can go to each of these names and decide whether you want to own it or not own it. And that is the approach we take. So there are some out of 100 stocks, 20, 30 odd stocks, you can eliminate right away based on forensics, based on quality of the business. You're just not comfortable owning them. So they are out of your universe. Out of the other 70, you look at space that where valuations are very, very elevated, or where you don't think the business operational parameters are sustainable, you eliminate a lot of them. And then you end up with, let's say, 30 or 40 odd stocks that is in your consideration set. And you decide based on your understanding, your approach, which are the 20, 25 odd stocks that you want to own. So the process actually is very, very simple.
So how differently do you manage both these funds, equity as well as hybrid? Is there any strategy different of buying stocks in the portfolio? Because hybrid, you might be looking at the quality stocks or the stocks which might, have a higher allocation towards the benchmark. So what's the thing? How do you balance the risk and reward in this both the segments?
नहीं, see, Chirag, I don't differentiate. In my mind, there is one best risk return portfolio. Basically, you think of it as model portfolio that I want to express across my funds. Now, in some cases, there are restrictions. For example, in the large cap fund, if we reach a point where a lot of mid cap and small caps become attractive, I cannot own all of them in my large cap fund, but I can own them in my hybrid fund. Because in hybrid fund, there are no restrictions in terms of market capitalization. So if you ignore some of those differences, there is significant overlap between the portfolios that I manage. Because see, even as a trader, I found it very almost impossible to think of two different portfolios. So I cannot say that this portfolio is right for you, while this is a portfolio that is right for somebody else. I do not believe in that approach. And the different, somebody who's picking an hybrid fund has different goals in mind, but that has been taken care of by the asset allocation, by the structure of the hybrid fund itself. Again, the third point, structure meets activity. So the whole point of running this in this kind of structure is it reduces the decision that I am taking as a fund manager, and in some cases it also reduces the decision that the investor is taking, and that is what kind of improves the odds as far as eventual investing outcomes are concerned. I think hybrid funds. That is the reason they make a lot of sense for a lot of investors, from small investors to large investors to HNIs, family offices, everybody.
Okay, and hybrid funds, how do you manage the equity portion during volatile markets?
See, already the volatility in hybrid fund is lower. For example, if you look at the aggressive hybrid category, anyway, 70% equity.
Right.
Now, if you say that I want to treat this, even the 70% equity differently, then you are just trying to damp down the volatility by too much, and it will come at a cost. Anytime you want to reduce volatility, it eventually comes at some cost. So I do not try to do it. So whatever I am doing in my large cap fund broadly, the same thing to the extent possible, given the constraints of the SID, is reflected in the equity portion. Whether the volatility will be higher or lower, that is determined by the asset allocation. So if somebody is not okay with even 70% equity exposure, he can go for a balanced fund or even a conservative hybrid fund. So that choice is left to the investor. I look at the equity portion with the same lens. I don't differentiate.
And Abhishek, even in the sectoral underweights and overweights is the same thing in both the things?
Very similar. I mean, as I said, in my mind, it's same portfolio. See, at this point in time, it's also easier because anyway, even in an unconstrained fund, let's say in aggressive hybrid, where I do not have caps on sectoral on market cap allocations, I have a large cap bias. So I mean, what I'm saying is, even if I was running a flexi cap fund, I would run a 70-75% odd large cap exposure. So that makes my job easier. If we get into a situation like 2012, 2013, where mid cap and small cap space is very, very cheap, then obviously the portfolios will look different because there's only, I mean, certain allocation that I can have in my large cap fund to the small cap and mid cap category. I can run my aggressive hybrid fund like a small cap or a mid cap fund. Fortunately or unfortunately, that is not the case in today's market. Today's market, I think large caps is where I am more comfortable with. And that is why even more overlap today than what you can expect when mid cap and small caps are more attractive.
So if there are attractive propositions when the market's correct, or if the small cap and mid cap are attractive, then you will not mind investing in that in the hybrid.
100%. So you forget if market gets, even if let's say 10 odd stocks or 15 odd stocks where I have significant confidence that the risk returns are favorable, I'm okay having a larger exposure in my hybrid funds to the mid cap and small cap space.
Abhishek, with inflation, global shifts, and geopolitical risks, what is your take on equity markets in the near and long term?
Yeah, so near term, though, I think nobody knows. See, medium term, what we have gotten used to is this If you look at 10-year rolling returns, 13 odd percent kind of return. Any index you pick, Nifty 50, Nifty 500. So 12.5 to 13% is what you have made, and this has become the expectation. Now, one caveat here is when you are looking at history, we were probably, these are nominal returns. So you have to factor in that we were running much higher inflation at that point in time. Today, inflation is lower, is expected to be lower. So let's say 5 odd percent. So even if you make the same real return, your nominal returns have to come down. And no matter how you look at markets today in India, it's hard to come at a conclusion that they are cheap. So they are not cheap. Put one and two together, your return expectation over the medium term should be slightly lower than what you have made historically. So historically, if you have made, 12, 13%, maybe you should expect on an index basis 10, 11% over the medium term. Medium term is what? 5 to 10 years, whatever you can pick, some number in between. So that is what should be the return expectation from the market. And some of these nuances globally, thankfully, India has seems a little isolated at this point in time. We'll probably, we will get impacted, but hopefully we'll weather that volatility slightly better than a lot of other emerging markets.
Abhishek, we spoke about it, but you have talked about evaluating the painful ideas, investing in business where sentiment and outlook are particularly negative. Can you share some examples of when this approach paid off and what strategies helped you to capitalize on these situations? Of course, don't give me a strong idea, but in a sector or something like kind of thing.
Yeah, so see, one of my favorite examples is tobacco, for example. So we had large holdings in, we even currently have a large holding in the largest tobacco company. And it was available at a point. See, there are two things. When it's not enough for there to be pain in stock prices, there has to be pain in valuation as well. Today, a lot of quality stocks have not performed for the last 3, 4, 5 years in some cases. But if you look at their valuations, they have not corrected. So the pain that we talk about, they have to reflect in valuations of the stocks. So in case of tobacco, it was trading, the tobacco business, cigarettes business was trading at less than 10x price to earnings multiple. This means X growth. You basically, market is saying that this business or the profits of this business is not going to grow forever. It will stay flat. That is what is implied by that multiple. And we give this anecdote that in 1604, in year 1604, King James of England, he wrote a book on tobacco. He called it loathsome to the eye, hurtful to the brain, things like that, and says it should be taxed. And he instituted a tax on tobacco in 1604. And for the last 400 years, we have been talking about taxing tobacco. It's a bad thing, and I don't disagree. It is actually quite bad. But this sector or stocks in this sector have been one of the best wealth creators across the globe. And if you look at all this history, look at recent history where what was the growth in terms of profitability and different tax regimes in different kind of markets, you could come at a conclusion that this is too benign. They will be able to grow whether 2%, 3%, 5%, 7%, we don't know. So we bought a significant position there and it has worked out well. Pharma, for example, 3 years ago, all of the exports business in multiple cases, in multiple stocks, was available for free, in some cases at negative value. And then you say that I don't know whether the value should be 10% positive, 20% positive, 50% positive, but negative is probably too harsh. And then you start buying. The courage that you need or that you have at that point in time when you're buying these painful ideas is not on how well the business is going to do, but how much bad can it get from here. If that is limited, if you think that things are already pretty bad and maybe 10%, 15% downside is what you're looking at, then that gives you courage that you can start building positions there.
Just wanted to understand on the, for example, like Asian Paints or Hindustan Unilever, which are going down, which have not given return for quite a few times. So what's your view on that particular thing? Will you be, willing to invest at this point in these stocks at this point of time?
If you look at the consumption space, if you look at the largest FMCG company in Indonesia, it's around 75%. If you look at Nestle, listed in Switzerland, the parent, it's again down, I think 55, 60 odd percent from peak. If you look at 30-year returns of that stock, it's 8.8% TRI, including dividends. This is as quality a company as you can think of. And 30-year returns have been 8.8%. So this, I mean, the first thing that you should notice is you cannot buy quality and hold it for a long time and hope and just expect that you'll do well. It's not a given. The idea is not to buy good companies. The idea is to buy something worth 100 rupees for 80 rupees or 70 rupees. If you look at the kind of re-rating that some of the consumption stocks saw from 2012 to 12-13 onwards for the next 7-8 years, it was phenomenal. And a large part of it was driven by margin expansion. So top line growth is pretty stable. So they grow in single digits, in some cases low double digits. But margin expansion is what kind of gave you the tailwind on the EPS number. So EPS growth was very, very healthy. Now we are sitting at a point where EPS is probably going to track top line. So margin expansion, you should not be building in. The best case is probably that we stay here. In that case, a lot of these stocks are still trading at 50, 60x kind of price to earnings. It's hard to come at a conclusion that the market's expectations are conservative in this space. And there's something, I mean, there could be one or two odd stocks that fall into that category, maybe not today, maybe 6 months down the line. So we'll look at that space. But overall, on an aggregate basis, is that a space that is very, very attractive at this point in time? I find it hard to come to that conclusion.
Abhishek, you've emphasized the importance of determining stock weights in your portfolio without being overly concerned about benchmarking. So,
Yeah.
how do you decide on stock weights in your portfolio? What are the key factors that you consider, and how does
Yeah.
the strategy enhance performance?
Yeah, so sizing is actually very, very important, and everybody kind of accepts that, but very few people who have a framework-based approach to sizing, because again, nuances. There are a lot of nuances, and it's not easy to do. So we also have a very, very formula-based kind of sizing framework. I mean, so you can basically use a version of Kelly's criteria and decide based on the upsides, downsides, base case, worst case, best case. What is it? So we have a system which can throw a value. So it can say that this position should be 60% of your maximum size. You can decide for large caps, my maximum size will be 8%. For mid caps, it will be 5%. For small caps, it will be 3%. So you decide your maximum size, and then that formula can tell you that you should be 70% of your maximum, or 80%, or 100%, or zero, whatever. The other thing, so we look at those numbers. But the other thing that at least I try to do is, if your maximum position in certain stock is, let's say, 5%, and the stock is going through that pain period where things are not looking great, where you are concerned, management is concerned, most of the buy side and sell side reports are very, very bearish. But you think that now we are at a point where things seem too bad, and things should start looking up. Then you build a base position. So you buy 1%, 2%, and you try to scale up as the stock or as your hypothesis starts. They start delivering on the hypothesis. And one way we track that is we also have a objective factor-based model. So it basically you get objective scores on in terms of there are multiple parameters to it, but fundamental delivery, momentum in the stock, price momentum, stuff like that. When the scores start improving, that is when you start kind of sizing it up. So a formula-based number, your own view on the fundamentals of the business, where we are in the cycle, and that supplemented with a objective factor-based score. These are the things that kind of get into the whole sizing bit. In very simplistic terms, your biggest positions should not be positions where you are expecting the biggest upside. Your biggest positions should be those where you are expecting where the downsides are lowest. So that is a very, very crude way of putting it.
Abhishek, since taking over the DSP Aggressive Hybrid Fund in March this year, It has outperformed peers by a handsome margin, 5%. What were the key factors driving the impressive performance?
See, Chirag, so one of the reasons why we struggle, by we I mean everybody, the fund managers, the channel partners, and the investors, is because we get too excited with this 5 month performance, or sometimes too despondent when this performance is not right. So as I said, forget 5 months, 1 year, 2 year, 3 year is noise in equity. So you should not be looking at these parameters. Very simple reason is, so when I took over, if you look at the returns in the previous period, some of our large holdings had struggled, and the operating delivery was good. Some of those came back. So very simple reason that some of the large exposures, they did well over time, and the idea is to kind of do it over full cycles, and not be too focused on this 1 quarter, 2 quarter, 5 month, 1 year kind of performance. In terms of the aggressive hybrid portfolio, was one, the share of large caps has gone up. Two, because I run a more valuation conscious portfolio, at least 5-10% of the portfolio, which was in bucket where I thought the valuation was extreme, that was toned down. And I ended up selling a lot of industrials and some infra names as well. If you look at my large cap fund, I have zero infra or industrial exposure at this point in time. So some of that also got reflected, and the market correction, I think some of those things helped.
Vishal, another thing was in with our last conversation around March, you mentioned plans to streamline the funds by reducing the stock count to
Yeah,
35 and increasing the large cap
correct,
exposure to around 70 to 75%. But currently, if
correct,
you look at it, it's around 47 stocks with 60% in the large cap. What progress has been
correct.
made, and when can investors expect the desired structure?
Yeah, so what I mentioned was it's 40 plus minus 5 for the hybrid category. We are currently at 45. So as of today, I have 45 stocks in the fund. See, one reason initially is there are a lot of names in my large cap fund that I think of as core position. So first of all, you include those names. So many names that were not in aggressive hybrid fund, we introduce them. M&M, for example, or SBI Life or ITC, these names, you introduce them. And then some names were reduced. But net, the impact has been from 51 names, we are down to 45 odd names. So we are in that limit. But ideally, I would want to be closer to 40 or preferably below 40, and that will happen over time. So the direction is clear. We'll move to lower names, lower number of stocks in the portfolio.
Any time frame particular or?
Chirag, it's hard to see because, as I said, you are some stocks. The hypothesis is something is you are looking at maybe another. You are looking at how the cycle is going to pan out. You are looking for maybe 1 or 2 quarters. So it might happen this quarter. It might take 2 quarters. In some cases, it might take a year. But the direction is pretty clear. I think 35 odd stocks, 30 to 40 is the range which gives you best diversification at the same time, best shot to kind of outperform the benchmark by consolidating your weights into ideas where you have high conviction. So the sweet spot is somewhere between 30 and 40.
While you've already shared what you're doing now with the aggressive hybrid fund, is there are there any other new strategies or adjustments that you plan to further boost the long-term returns?
Which hopefully, so see, your approach does not change, your framework does not change. Execution is something that you keep trying to improve. So that's a continuous process. But as such, see, recently we made fundamental attribute change in the aggressive hybrid category, and the fundamental attribute change was the limits that we were operating within for the equity portion was 65 to 75%. Now SEBI gives us that the SEBI defined limits are 65 to 80%. So that is another change we made, that if markets are very in case of a crash, or if markets are very attractive, we can go to 80%. So that is one change, and I fully intend to go to 80% whenever we get that opportunity. The other change that we made was, at this point in time, there are restrictions on global equity.
Right.
I mean, the limits are not available. At some point, hopefully, that opens up. So we will go wherever we can find value. So if something very very attractive is available in other global markets, we'll take exposures there as well. So these are two changes that we have made, which hopefully over time should help us.
All right. Now, last question. What advice would you give to first-time investors looking at hybrid or equity funds? How should they think about their risk, sector selection, long-term goals in their investment strategy?
My advice, and it pretty consistently I say this, is what matters is what product or what category can you stay invested with for the longest possible time. The reason is that now we have taxation, even long-term equity taxation. So if let's say your investment horizon is 30 years and you keep churning your portfolio every 3 years, you end up paying 13% tax, and this tax rate itself is kind of going up, most probably again in Feb. Then you will lose 25% of your net worth 3 years out just to taxes. So if you can just reduce churn in your portfolio, you will end up saving almost 25% over 30 years. How do you do that? If you're too cynical, too skeptical to choose an active fund manager, you pick an index fund, you'll do okay. Then keep doing your SIPs, keep investing in the index funds, keep doing it for 30 years. If you can pick 2 or 3 people who you are, and I think the evidence in India is still in the favor of active funds. If you can choose 3 people who you will be willing to stay with even when they are underperforming for the longest possible time, then you pick those 3 people. A lot of people in India, a lot of investors do not run more than 60-70% equity as a portion of their overall net worth. And the rest of the funds are either in fixed deposits or let's say debt funds where you end up paying marginal taxes in some cases. If that is your asset allocation where you are running equity, 60-70% equity, just pick 3 hybrid funds. And on a post-tax basis, you will do very well. You will not have to churn your portfolios. Hybrid funds by design buy when markets are down. By design, they end up selling when the markets are high. So they are long gamma structures. Pick anything which you have the confidence to stay invested with for the longest possible time. A long investment horizon takes care of many investing mistakes. So that is one piece of advice or suggestion that I'll offer retail investors.
All right. Thank you, Abhishek. Time for us to wrap up this chat. Thank you for this very interesting interaction. We look forward to speaking to you again.
Thanks, Chirag. Thanks, Ruchira.
Thanks, Abhishek.